Welcome to the Deep Dive, where we cut through the noise to unearth the truly important insights you need to know. Today, I'm genuinely fascinated by how Korn Ferry, this global consulting powerhouse, is navigating this choppy economic environment. They seem to be doing more than just surviving.
Yeah, almost thriving, right, despite everything.
Exactly. And they're making this big bet on a digital future, too. So we're diving into their Q1 fiscal year 2026 earnings call. It just happened yesterday, September 9th. We want to unpack the story behind the numbers, what it means for their big transformation plans.
And the market definitely reacted. Shares were up after the release, so clearly investors liked something they heard.
Okay, let's dive straight into the headlines then, the numbers that caught everyone's eye. For Q1 FY26, Korn Ferry reported an adjusted EPS of $1.31. That comfortably beat the analyst estimates, which were around $1.24.
A solid beat on the bottom line.
And fee revenue came in strong at $708.6 million. That's up 5% year over year.
Or 4% in constant currency, which is still pretty good. Also beat consensus there.
Right. Adjusted EBITDA hit $120.4 million. That translates to a robust 17.0% margin.
Which is actually up 50 basis points year over year. So profitability improved too.
Yeah. And beyond just the P&L, they showed commitment to shareholders. They bought back about 146,000 shares for nearly $10 million.
Part of a bigger $36 million returned overall, including dividends.
So strong numbers across the board.
What's really fascinating here, though, isn't just that they beat. It's how they beat. Management themselves call the environment choppy. So delivering this kind of performance, well, it suggests something deeper is going on.
Like real execution.
Exactly. It suggests strong execution, maybe some pricing power, and that diversification strategy they talk about. It seems to be working, insulating them a bit.
Okay, choppy environment, strong numbers. You mentioned diversification. Let's unpack that. How are the individual business segments performing? Because that's where we should see that strategy really playing out, right?
Definitely. And it is. Let's start with executive search. It just kept going. Grew 8% year over year in fee revenue, hit $224 million.
Wow, 8%.
Yeah. And get this. It's the fifth consecutive quarter of year over year growth for that segment. They pulled in almost 1,600 new engagements.
5 quarters. Even with all the uncertainty, that's pretty remarkable for high-end search.
It really is. It speaks to their brand, I think, and the fact that leadership is just critical when things are uncertain. Companies still need top talent.
Okay, so executive search is strong. What else?
Well, Professional Search and Interim also had a great quarter, up 10% overall to $134 million.
And how did that break down?
Permanent placements were up 5%, but the interim solutions part was up a really strong 14%.
Okay, 14% in interim. That seems significant.
It is. And management talked about this diversification flywheel. The interim business seems really synergistic. Clients come in for, say, an executive search, and then they ask for interim solutions too. It builds on itself.
So they're cross-selling effectively between those related areas.
Seems like it. They also mentioned, interestingly, that the contingent recruiting model, the more transactional stuff doesn't really fit their brand strategy, so they're being quite selective in that professional search space.
Got it. And RPO, recruitment process outsourcing. How did that do?
RPO delivered 3% growth. They secured $99 million in new business.
Okay, modest growth, but new business is good.
Yeah, and what's interesting is nearly half of that new business, 46%, came from totally new clients, new logos.
So they're expanding their reach, not just farming existing accounts.
Right, and RPO adds that valuable predictability. They estimate they have about $1.67 billion in fees under contract still to be recognized.
Wow, $1.67 billion.
Yeah, and nearly $1 billion of that is expected within the next 12 months, so it provides a nice visible revenue stream.
Okay, so the talent acquisition side, search, interim, RPO, look pretty solid, good synergies there. But what about the other side? Digital and consulting, how are those evolving, especially digital, given the transformation push?
That's the really interesting part, I think. So digital fee revenue was up only slightly, just 1% to $89 million.
Only 1%.
But, and this is a big but, you have to look inside digital. The subscription and license revenue grew 9% year over year.
Okay, 9% growth in subscriptions. That's different.
Very different. And that subscription piece now makes up 39% of their total new business in digital.
So the overall growth looks muted, but the quality of the revenue, the recurring part, is actually growing quite nicely.
Exactly. It looks like a strategic choice. They might be sunsetting older, maybe less profitable digital offerings to focus on building that recurring revenue base. It points towards that SaaS-like model they seem to be aiming for.
That makes sense. And this ties into the new platform they're launching, right? The Talent Suite?
Precisely. They're actively sunsetting the legacy platform. The big launch for the Korn Ferry Talent Suite is set for November, so Q3 of their fiscal 26.
And that's why there's that depreciation hit coming in Q2.
Yep. They mentioned about $10 million in accelerated depreciation, which is around 14 cents per share. It hits the GAAP EPS in Q2.
Which sounds bad, but it really just signals they're serious about this transition, writing off the old stuff faster.
Exactly. It's a clear investment signal. Their long-term goal, they said, is for subscriptions and licenses to be over 60% of digital revenue.
60%. That's ambitious.
It is. And they see the Talent Suite as an enabler for everything else they do, embedding their IP, their data, right into client workflows.
Okay. And consulting. Similar story there, or different dynamics.
Consulting fee revenue was also up just 1% to $170 million. But again, look underneath. Average bill rates were up 9%, a significant jump.
So they're commanding higher prices for their time.
They are, and their backlog is growing, with 42% of it now coming from these larger million-dollar-plus engagements.
So more strategic, longer-term projects.
Seems that way. They mentioned the average rate per hour has gone from around $300 to nearly $500 over the past few years. That's a 50% jump. Huge pricing power.
Wow. Okay, so better quality revenue in digital, higher value work in consulting. It does paint a picture of resilience. Management talked a lot about navigating the broader economy. What were the key messages there?
Well, CEO Gary Burnison basically said, yeah, it's choppy, but our strategy is working despite that. He pointed to the ongoing global uncertainty, cautious investment spending, geopolitical stuff, all impacting business decisions.
And did that show up regionally?
It did. The Americas fee revenue was actually down 2% overall. Growth in Exec search and RPO there was offset by softer demand in consulting, digital, and the Pro Search Interim side.
Okay. A dip in the Americas.
But EMEA and APAC were really strong. EMEA was up 19%, APAC up 12%. Broad growth across all their services in those regions.
So some regional divergence there. What's their take on this choppiness, this sort of prolonged uncertainty?
They have an interesting perspective. They think we've actually been in a kind of labor recession for about 2 years now.
A labor recession?
Not massive layoffs like in past downturns, but companies dealing with higher costs by just letting people leave through natural attrition and not rushing to replace them, sort of tightening the belt quietly.
Like a hiring slowdown rather than big cuts.
Exactly, a slow burn. But they also see opportunity in the chaos, as they put it. When things are uncertain, especially with big shifts like AI and Gen AI, companies turn to firms like Korn Ferry to figure out how to adapt, how to restructure, how to find the right talent.
So change creates demand for their services.
That's the idea. And on AI specifically, they're making substantial investments. They've centralized about 40 people to drive AI and Gen AI use internally.
How do they see AI impacting their own business?
Their mantra is human plus AI. They see it as an efficiency tool. It can handle routine tasks, freeing up their consultants' capacity to focus on higher value strategic work and deliver on that growing backlog. It's not primarily about cutting headcount, more about augmenting their people.
Okay, makes sense. Leveraging tech to enhance, not just replace. Looking ahead then, what guidance did they give for Q2?
For the second quarter, fiscal 26, they expect fee revenue between $690 million and $710 million.
Okay, so the midpoint, $700 million, is a little down from the $708 million they just reported in Q1.
Right, and they guided adjusted diluted EPS to between $1.23 and $1.33. The midpoint there is $1.28, also a bit below the $1.31 from Q1.
On margin.
Adjusted EBITDA margin expected around 17.0% to 17.5%, so still quite strong.
Why the slight sequential dip in the guidance, especially if Q2 is usually seasonally stronger?
Management basically put it down to conservatism. Given the macro uncertainty, they're being cautious, even though Q2 typically is a better quarter.
But the guidance still brackets consensus estimates.
Oh, yeah. It's still a solid outlook, very much in line with what analysts were expecting, perhaps even a touch better, depending on where you look.
And what do they see as the main catalyst going forward?
Well, firstly, just executing on this Q2 guidance. Secondly, the big one, the successful launch and uptake of the Talent Suite in November. Then continuing to win those RPO contracts, and of course, eventually benefiting when the overall hiring cycle picks up more broadly.
Okay, so tying this all together, what does it mean for you, the listener, watching Korn Ferry, or the broader consulting and HR space?
I think it strongly reinforces their story, their narrative arc. They're really trying to transform from being seen as just a cyclical executive search firm
Right, tied purely to hiring cycles.
into this more diversified organizational consulting platform. The strength we saw in search and interim, plus the visibility from RPO, and this major strategic bet on the digital talent suite. It positions them potentially to grow faster when hiring recovers, but also to be more resilient during downturns because of those subscriptions and longer consulting projects.
So less cyclical, more stable growth profile over time.
That's the goal. The market reaction, the stock being up, but maybe some volatility during the call. It suggests investors are weighing the good quarter against maybe that slightly conservative guidance and trying to figure out the pace of this transformation.
And how has it performed historically?
Well, over the last year, its total return did lag the S&P 500 and the industrial sector ETF XLI. But these strategic shifts, especially the talent suite catalyst, they could change that trajectory going forward if they execute well.
It's definitely a company in transition. Fascinating to watch. Okay, now for our regular segment. Remember, this is not financial advice. It's just an outrageous but plausible trade idea to get you thinking.
All right. My idea for Korn Ferry revolves around that transformation we've been talking about. It would be a long-term bull call spread.
Okay, a bull call spread. Betting on the stock going up, but capping the upside and lowering the cost.
Exactly. The rationale is this. The market, I think, still values KFY mostly as a professional services firm, maybe with some cyclicality baked in. But the full impact of this shift towards being a scaled organizational consulting platform with recurring digital and long-duration engagements, that might be really underappreciated right now.
You think the market hasn't fully priced in the talent suite and the subscription model shift?
Potentially not yet. The Talent Suite launch in November is the key catalyst here. It's a big architectural change designed to embed their IP in data. That goal of 60% plus subscription revenue in digital is huge.
And the depreciation hit in Q2 actually supports this view, in a way.
Yeah, it shows they're putting real money behind it. Plus, the whole human plus AI angle reinforcing the platform idea. So the trade is betting that as the Talent Suite rolls out, gains traction, and the financial benefits like higher margin recurring revenue become clearer, the stock gets re-rated.
Re-rated more like a software platform company, less like a traditional consultant or search firm.
That's the outrageous but plausible pitch. You'd buy a call option, maybe near the current price, and sell a higher strike call, both with an expiry date well out into the future, maybe January 2027, to give the strategy time to play out.
So capturing upside if the re-rating happens post-Talent Suite success.
Exactly. The outrageous part is banking on a significant multiple expansion. The plausible part is that the strategy is clear, the investment is real, and the long-term vision makes sense.
Interesting idea. Again, definitely not advice, just food for thought. Okay, so that wraps up our deep dive into Korn Ferry's Q1 FY26 earnings. We saw solid beats, clear evidence of their diversification strategy working in a tough climate,
Especially in search and interim.
and these significant calculated bets on their digital future with the Talent Suite coming soon.
Yeah, I think the key thing for you to watch now is execution. Do they hit that Q2 guidance? How does the Talent Suite launch actually go in November? Is there quick adoption? And longer term, how does integrating AI really change how they work and what they offer clients? It's a great case study in how established companies try to reinvent themselves.
Can they truly become that tech-enabled platform? That's the big question. Remember, the insights shared today are strictly for informational purposes. They are not financial advice. We always encourage you to do your own thorough research. Thank you for joining us on the deep dive, and we'll be back soon with more in-depth earnings analysis.